We've got Azlin Ahmad joining us this morning, editor Crude Oil Markets. We've got him on the phone line. Azlin, good to have you with us. And I think we have Arvind Sanger with us as well from Geosphere. Let me come to you first on the fall in crude. Azlin, really just knocking everyone back. We're seeing the reaction across the screen this morning. Are you, our oil experts, are you taken by surprise at Saudi's move? Did this come completely out of the blue? And more than that, is this the beginning of a bigger war then?
Yes, I think that the non-agreement between in the OPEC Plus was, I think, quite a surprise for the market, because for the whole of last week, there had been a lot of talks about output cuts, although the amount of the output cut was still uncertain, and it went from recommendations of 600,000 barrels per day to 1 million barrels per day to up to 1.5. So I think a lot of that was already factored into the market, and we did see that Brent was climbing slightly above $50 at the low 50s. And so that the news that came out that Russia basically walked away, and without Russia, OPEC, led by Saudi Arabia, doesn't want to continue the output increase, will not be. I think that was a big shock to the market, and we saw the reaction this morning immediately when we saw the crude prices. I mean, Brent came down by, I think, about $14 early in the morning, and then recovered slightly. So we're about low 30s or 35 right now for Brent. So it is a shock to the market, and I think that's why we're seeing such a big drop in the prices this morning.
Yes. Clearly, Azlin, this is a part of Saudi strategies to snatch some of Moscow's market share. But how low do you think they're willing to go on the price front? I mean, are we looking at anything possibly below 30? Because wouldn't that impact them as well?
Yes, I think that the way right now, with the reduction in demand because of this coronavirus, I mean, demand growth figures have been revised over month, I think. And our expectations just right now is that we still see that there could be oil demand growth of around the 500,000 barrels per day. But that is something that the Argus consultants are constantly looking at and could potentially revise. So that demand growth has already been revised quite significantly lower compared to the month ago. So I think that right now, in the very short term, in the next few days, we could see prices fall further. I mean, especially when the European traders come into the market later this afternoon. So it's hard to say where the floor is. I think the immediate reaction is that we could go down to $30. It's very possible we could go down below, but the threshold, and maybe it's hard to say where the threshold is for producers like Russia to maybe rethink its decision or to come back to the negotiation table. But yes, I think that, as you say, this is a price war, and it's very hard to say how much lower price will fall, because on the flip side, it's not just supply, it is how bad demand is going to be. And I think that's something that right now no one can accurately predict, depending on what happens with the coronavirus outbreak.
Right. Arvind Sanger also with us. And Arvind, would you concur with that last point that was made, that at a time like this, when we're seeing this absolute meltdown in crude oil prices, this is far more dire than the situation that we witnessed in the year 2014, largely because of the fact that there has been a significant collapse in demand due to the coronavirus. And given how volatile and uncertain the situation is on that front, the prognosis for the oil market as well seems a bit unknown and dire.
Well, clearly, I think this is worse than 2014 for two reasons. One, as you correctly identified, the demand has badly fallen out of bed. The other part is, I think there is, in my opinion, a miscalculation by the Saudis, thinking that the Russians, or maybe there's no miscalculation by the Saudis thinking that the Russians will give way first, but the Russian budget works at $40 oil. Saudi budget works at $75 oil. So Saudis are far more vulnerable to lower oil prices than the Russians. I think the eventual game here that the Russians are playing, which is really the ones that force this hand, is to force the shale oil producers to go out of business in large measure, and therefore balance the market. So I think the real pain adjustment will come from shale producers. That'll take a few months. In the short term, oil prices can go till we get to the marginal costs of producing oil at some of the costlier producers, which would be either some of the heavy oil producers in places like Canada, or it could be some of the North Sea or other places, and that could take oil, $20 or lower before they shut in our production. Because as we've talked, demand is going to fall out of bed. Saudis are increasing output. Russia is clearly not cutting anything. So this is a disorderly move, which reminds me somewhat, although not exactly, of what happened in 1986 when the Saudis got tired of producers supporting the market and let oil get to $10 a barrel. We're in a different world where costs are higher, but certainly it could go to 20 or lower in the short term, because there is no rational bottom till enough production gets shut in to balance supply and demand, and lower prices are not going to do much to stimulate demand in a period when people are scared of traveling or flying because of coronavirus fear. So lower prices are not going to fix demand side. They're going to have to be fixed on the supply side.
What does this sort of a crash or the way asset prices are going down, means for equities? How would markets react to, some of the stocks and sectors which are still growing? You think it's not about numbers now, it's more about the price and how people can exit?
Well, if we were looking at India in an oil price correction, India is a winner. But when there's a global economic slowdown or a meltdown, India has never been a winner, right? If oil is going down partly because demand is very weak, that does not help any economy, and India is no island in that. So in that sense, I think asset prices are going lower, and obviously interest rates are going lower too. But interest rates and oil prices will not work till we get a sense of how deep is the economic correction going to be. And this becomes kind of a self-fulfilling and self-feeding slowdown where, destruction in equity value will also further cause, economic pain and therefore further slowdown. So we have to see how it goes. But let's be clear, the coronavirus impact, hopefully, and everything we've seen and read so far, is going to be short-term, whether that's 2 months, 3 months, 4 or 5 months. And when we come out on the other side, there could be, quite rapid recovery in stocks and equities and economic performance. But we have to get through the valley on the other side. And I think people have been in too much of a bull market mood of trying to buy every dip too quickly. And our opinion has been to be kind of, go very slowly. And I think that's going to be the message from the market correction today.
Okay, Arvind, request you to stay on with us because we will be analyzing the crude price fall as well as the implications for India and other asset classes. Azlin, before I let you go, given that now predictions are of $20 perhaps in 2020, I just want to understand what this crude oil fall means from an India standpoint as well as the kind of geopolitical implications that it has.
Well, I think for India, because India is still a net importer, I think that it'll probably be quite good for the many of the oil companies, except for the upstream companies like Vedanta, I guess. But India is still importing quite a lot of crude, and for the oil refiners, lower oil prices is still good. But on the flip side, it's just that right now demand is falling, and jet fuel demand is falling very sharply. Gas oil prices may fall because of the lower industrial activity in China because of the shutdown. So I think that you have to figure out, you'll have to see which falls faster, whether the product's demand is going to remain depressed, which doesn't help refiners in India or anywhere else, or whether in a few months' time the demand for products will start to recover, and if crude is low, then the crack spreads and the margins for refiners would start to improve. So I think right now it's really very uncertain. We'll have to see whether the demand for oil products, because of the shutdowns and because of the spread of coronavirus, falls faster than the crude price falls. And I'm, at this point, not able to forecast.
Let's take a very quick break. I mean, the fact that there's so much uncertainty, of course, and we'll in fact go across to Jayesh in a moment as well on the technicals. Azlin, of course, running us through the kind of looming uncertainty there is currently post that crash, and Arvind also saying he's not seen anything like this in a very, very long time. So we're going to go back across to him in a moment. But Jayesh, on the charts, take us through some of the critical levels that we're tracking today, some of the levels that have already been broken.
Abba, it promises to be a manic Monday after the freaky Friday that we had last week. But to talk about levels, SGX Nifty in the morning was trading below the corporate rate tax cut day, which was 10,691. And the Nifty is most likely to open below that level. So we would have essentially given up all the gains that we had accumulated since that day, which was 20th of September. Even for the Nifty Bank, a deep correction that we are staring at, because this has been the worst drawdown that we've seen since 2016. Remember, 2015 and 16, that is the period of the markets when the Nifty as well as Nifty Bank corrected more than 20%, slipped into bear market territory. Post that, we've had a significant run-up, but this is the actual test of time that presents itself. Key indices that you need to focus on, which are at 52-week lows, would be the PSU banking stocks, the auto stocks, as well as some of the metal counters. So these three key indices have been trading with deep cuts at 52-week low. Global assets, if you have a look at it, why we are seeing such a big fall Monday morning is primarily because of oil prices, which have cracked more than 20%. And, this is the biggest single-day drop that we've seen since 1991. That's almost 3 decades that I'm talking about. Amidst all of this, what has actually stood out is gold prices, which have reclaimed $1,700 for an ounce. And, once again, we are seeing some bit of traction come back into safe haven buying.
For that, let's go back to Arvind Sanger. He's still with us. Arvind, BPCL is on the block, or looking for a strategic sale. EOI have been invested. With the sort of problems that you're seeing in crude market, the way crude is crashing, do you think that the demand over there could be low, or it doesn't matter when you're a strategic investor?
Well, I mean, the strategic investors are usually, oil countries or oil companies, and none of them is feeling very rich right now. So I think that this is not a great time. Although downstream companies will be less impacted by lower crude prices, but they'll be impacted by lower demand. A company like BPCL by lower demand for products. So this is not a great time. In a time of such enormous uncertainty, I'm hoping that the Indian government is not counting on any urgent sale happening anytime soon. But I think, in 6 months, could a strategic buyer emerge with some reasonable price willingness to pay? I think so. I would, if I were advising the Indian government, be saying that, let's not be in a rush. Let's wait for demand to stabilize and recover before, finalizing any bids for BPCL.
To take a broader view for a moment, at this point, I don't see any asset class holding up, whether it be bonds, currencies, emerging markets. We're seeing a pretty much around the world sell-off on the back of Corona, and now what's happening on oil. Since we're talking historically, when's the last time you saw this kind of a fall? Look at Asia this morning. Look at what's happening on the bond markets. It's really free fall today.
Yeah, it looks like 2008, to be perfectly honest, both the elevated volatility, multi-day, multi-week elevated volatility, and the magnitude of the equity, commodities, everything sell-off. I think this last time we saw was 2008, which was for very different reasons. But, for people who were making the case, as I think you had some chartists making the case last week on your program of comparing this to the Greek crisis or other times when volatility got elevated. Those were one-time, short-term issues. This is much more, deep-rooted with no historical precedent to judge. Eventually, the market sale will be over, or eventually will be oversold, and it could even be that today could be the big, big puke, so to say, sell-off. But my advice to investors is till we know, and that's the advice we're following for ourselves, till we know the extent of and the depth of the coronavirus, impact on on economies and on health of countries and on actual debts and everything else, till we get some sense of the magnitude of that, there is absolutely no reason to rush out and kind of try to pretend like this is time to bottom fish in a big way. I think high quality companies, when they get cheap, are worth buying, but slowly.
All right, Arvind, we'll leave it there. Thanks for joining us. Somewhat of a move in gold, a little bit on the yen, and that's pretty much it. That's where we're at this morning.